Hello and welcome to The Explainer. Today we're digging into a question that sent a real shiver through the financial world. Is the U.S. banking system teetering on the edge of another crisis? So let's get right into it. It all kicked off on October 16th, 2025. A sudden panic just gripped the regional banking sector, and all at once, everyone was asking the same question. Is this a repeat of 2008, or is it just a temporary blip? So what was the trigger? A fraud disclosure. Two banks, Zions and Western Alliance, came out and revealed they'd been hit. And just look at this chart. Their stocks didn't just drop, they absolutely plummeted. And they dragged the whole sector down with them. The main index fell nearly 7% in a single day. That's a huge move.
But here's the thing. The market's reaction wasn't really just about fraud at a couple of banks. It was about something much bigger, a structural weakness that's been ticking away like a time bomb right under the surface. And that time bomb is a massive overexposure to commercial real estate, or CRE. I mean, just look at this concentration. For these regional banks, a staggering 44% of their entire loan portfolio is tied up in commercial real estate. To put it another way, that's a massive, all-in bet on a single and pretty volatile sector. And this slide really shows you just how risky that bet is. You compare that 44% to the biggest, most diversified banks. For them, CRE loans are only 13% of their business. So this isn't just a small difference in strategy. It's a huge difference in vulnerability.
And this vulnerability is coming at the worst possible time. The CRE market itself, it's under extreme stress. Delinquency rates on office loans are getting close to 10.4%. That's nearing the levels we saw during the 2008 financial crisis, and they're climbing at the fastest pace ever recorded.
And all of this is hurtling towards a massive deadline. In the industry, they call it the wall of maturities. Over $1 trillion, that's a trillion with a T, in these commercial real estate loans are due for refinancing by the end of 2025. Now, with property values down and interest rates way up, a lot of borrowers simply won't be able to pay. You can see how this sets the stage for a potential wave of defaults. But, despite that really scary picture, there's a strong counter-argument that says, hey, hold on, this is a containable problem. So let's take a second and explore the optimistic view. Okay, so the optimistic case pretty much rests on three main pillars. First, there's the belief that this fraud issue is isolated, not a sign of systemic rot. Second, the idea that the Federal Reserve is going to come to the rescue with rate cuts. And third, that a better geopolitical climate, especially with some progress in U.S. China trade talks, will help calm the markets down. And you know what? There was immediate evidence to back this up. The very next day, the market rebounded, and it did so sharply. Zions, one of the banks that got hit the hardest, saw its stock jump back up 6%. It was a really clear signal that many investors thought the initial panic was just a total overreaction. And this view was backed by some major analysts. The brokerage firm Baird went and upgraded the sector, calling the sell-off disproportionate. And the big rating agency Moody's affirmed that the overall U.S. banking system is still sound, pointing to the strong capital buffers at the major institutions.
Okay, but there is a much darker way to interpret these events. One that sees this not as a contained issue at all, but as the first tremor before a major earthquake.
This view is probably best summarized by that now famous warning from JPMorgan CEO Jamie Dimon. When you see one cockroach, you know there are more. His point is pretty stark, right? The problems we're seeing right now aren't the whole story. They're just the first ones to crawl out from the shadows. So from this perspective, a one-day market rebound, it changes absolutely nothing. The fundamental facts are still there. That 44% exposure is a massive vulnerability. That trillion-dollar wall of debt is still coming for us, and the risk of a credit crunch that could choke off the real economy, well, that's still very much on the table. And that's the crucial point. If these highly exposed regional banks get spooked and just stop lending, it's going to disproportionately hurt the small and medium-sized businesses that rely on them. And those businesses are the engine of the economy. Cut off their credit, and you could easily trigger a full-blown recession. So we have two completely different stories. One is a temporary scare, the other is a looming disaster. The big question is, where does the balance of risk actually lie right now? Well, ultimately, it really all comes down to a race against time. In one corner, you've got that trillion-dollar wall of debt, and the deadline is coming up fast. And the other corner, you have the Federal Reserve, which is signaling it might cut interest rates twice before the year is out. The question is simple. Can the Fed act fast enough to defuse the bomb before it goes off?
And adding to that, Fed Chair Powell has also hinted at ending something called quantitative tightening, or QT. Now, this is a bit technical, but the bottom line is it would inject more liquidity into the financial system and help ease the pressure on the markets.
But the path forward is anything but clear. That massive loan deadline is just 2 months away. A fragile U.S. China trade truce could collapse in November. And, just to make things worse, an ongoing government shutdown means we're kind of flying blind without the key economic data we need to see what's really happening. So, where does that leave us? Honestly, with delinquency rates already at 2008 levels and the clock ticking on that trillion-dollar wall of debt, the balance of risk really seems to be tilted towards the pessimistic side. The problem is real, the exposure is high, and the deadline is very, very near. Which leaves us with the critical question you see right here. Is the system resilient enough to absorb this kind of shock, or is this just the first domino to fall? The next few months are going to be the ultimate stress test. They're going to tell us if that recent market rebound was a sign of real strength, or if it was just the calm before the storm.
We'll be keeping a very close eye on all the latest developments. Thank you so much for joining us for this explainer.